You see it all the time. Incredibly smart, successful professionals making absolutely disastrous decisions the very second they put their money into the financial markets. So why does this happen? Well, today we're exploring that exact paradox. We're going to unpack why our brains are literally hardwired to fail at investing, and more importantly, how you can rewire your approach to actually build serious, lasting wealth.
Hello everyone, welcome to the Capital Intelligence Channel. In this explainer, we're cutting through all the noise. We are delivering the absolute essentials of market psychology, the high-value insights that anyone serious about finance and investing really truly needs to know.
Here is our roadmap for this explainer. We're going to cover 1. The psychology of investing, 2. Anatomy of market FOMO, 3. The global FOMO index, 4. The cycle of investor emotions, 5. The cost of chasing returns, and finally, 6. The patient wealth strategy. Let's get right into it.
Starting with Section 1, the psychology of investing. Let's look at the biological flaws that make us naturally terrible at navigating modern capital markets. Okay, so the absolute core of this whole problem is FOMO, fear of missing out. And look, it's not just some trendy social media buzzword, right? It is a profound psychological trap. It's that gnawing, pervasive anxiety that hits you when you perceive that other people are making money on something you're currently excluded from. And that deep-seated anxiety is exactly what pushes otherwise perfectly rational people to just jump blindly into the market right at the absolute peak of prices, totally bypassing any logical due diligence.
But what's truly fascinating here is that FOMO doesn't work alone. It's amplified by this potent evolutionary cocktail of cognitive biases. Think about herd mentality. The data actually shows that a mere 5% of informed investors can trigger the other 95% into mass buying or panic selling. Then you've got loss aversion. The famous behavioral economists Kahneman and Tversky proved we feel the pain of losing money about twice as intensely as the joy of a similar gain. Throw in recency bias, where we just assume whatever recently happened in the market is the new normal, plus overconfidence on our ability to time our trades perfectly. And you've got a recipe for total cognitive overload that just routinely overrides rational thought. Which brings us to Section 2, Anatomy of Market FOMO, where we'll see how these emotional impulses actually play out when real money is on the line.
If you are genuinely serious about your finances, you have got to draw a hard, uncrossable line between investing and speculating. Investing is all about intrinsic value. You own a good business for its cash flow, its logic, and its long-term potential. Speculating, that is entirely driven by emotion and price chasing. It's buying a trendy asset just because you're hoping someone else, the so-called greater fool, is going to come along and pay you more for it later. The second you let FOMO dictate your actions, you cross that line. You stop being an investor and you become a speculator.
Nobel laureate Richard Thaler hit the nail right on the head regarding the danger here. He said, when emotion takes the wheel, especially fear or urgency, investors tend to underperform the very markets they're reacting to. These financial failures, they don't happen because we lack access to information. They happen because we're fundamentally human, and our emotional wiring simply wasn't built for the modern stock exchange. To prove this isn't just theory, let's move to Section 3, the global FOMO index, and see how we can actually measure this regret. Economist Joseph Bonaparte spent 2 decades studying this by tracking millions of Google searches. He created what he calls the global FOMO index, looking for specific red flag terms like buy stock, get rich quick, Bitcoin price, missed out, and trending now. And what he found should be a massive wake-up call for all of us. When millions of people suddenly type these exact phrases into search engines, they are not uncovering some brilliant hidden opportunity. They're literally just documenting their late arrival to the party. Bonaparte's data is incredibly revealing. He found that when search interest for these FOMO terms hits its peak, it actually predicts a 1.7 to 2% decline in future market returns. Furthermore, it predicts a massive 4% drop in risk-adjusted performance. So basically, when search interest spikes, your future returns vanish. Think of it like a super hyped-up restaurant. You know the exact kind I mean. It's all over social media, everyone is raving about it, and you cannot get a table to save your life. By the time you finally get a reservation weeks later, the kitchen is totally overwhelmed, the food quality is deteriorated, and you're left sitting there wondering what the big deal was. Well, financial markets work exactly the same way. Peak popularity signals peak prices, not peak potential. If you're getting an investment tip from an influencer or your neighbor, I guarantee you the real opportunity is already gone. Let's look at Section 4, the cycle of investor emotions. This data maps perfectly onto the predictable roller coaster we see in every market cycle.
Every single cycle takes investors on this exact same emotional journey. It starts with optimism and thrill as prices go up. This builds and builds until it peaks at euphoria, which, ironically, is the point of maximum financial risk. When the market inevitably takes a dip, we feel anxiety, then denial, until we finally bottom out in panic and capitulation. And here's the real tragedy. Panic is usually the exact moment of maximum financial opportunity. If you don't have a disciplined plan, your own biology is going to doom you to buy high during euphoria when everyone's greedy and panic sell at the absolute bottom when everyone is terrified.
Moving on to Section 5, the cost of chasing returns. Let's agitate this a bit and look at the actual financial damage this causes.
Let me show you what wealth destruction actually looks like. The 2024 Dalbar report showed that the average equity fund investor trailed the S&P 500 by a massive 5.5 percentage points in 2023. And to be perfectly clear, this gap isn't because of high management fees or a lack of access to data. That 5.5% is purely the behavioral penalty. It's the literal cost of emotional market timing, buying high, selling low, and abandoning your long-term plan just to chase the current hype.
The empirical evidence against market timing is absolutely brutal. William Sharpe's famous research showed you would literally need to be right 74% of the time just to beat a basic passive index fund. Meanwhile, data from StockTwits reveals that retail traders who followed social media sentiment ended up suffering 40% declines on their investments. But here is the craziest part. Sophisticated AI trading strategies are now generating 13.4% annual returns by deliberately trading against retail sentiment. Think about that for a second. Institutional algorithms are quite literally programmed to profit off of your FOMO and panic.
So how do we fix this? Let's pivot to Section 6, the patient wealth strategy, and outline the professional-grade frameworks you need.
Your ultimate defense against FOMO isn't trying to just suppress your emotions. That never works. It's creating an investment policy statement, or an IPS. This is a pre-commitment anchor that you craft during calm, rational periods. It clearly spells out your target risk level, your expected return ranges, your long-term goals, and strict rules for rebalancing your portfolio automatically. By getting these rules written down, you create a massive psychological barrier that stops you from making disastrous split-second choices when the market tanks or the next big hype cycle starts up.
Building true wealth relies on really boring but mathematically superior strategies. We're talking about leveraging broad market index funds, harnessing the absolute exponential power of compound interest, and automating your rebalancing. Now, I know what you're thinking, what about that human itch to just gamble a little? Well, the professional framework says to cap your speculation funds at just 0.5% to 1% of your entire portfolio. That way you can scratch that speculative itch on the next crypto or meme stock craze without ever putting your actual financial security at risk.
So take a hard look at your own portfolio today. Ask yourself, is your wealth built on a solid, evidence-based foundation, or are you just chasing the herd? Achieving real capital intelligence means stepping away from the noise. Thank you so much for joining me for this explainer. I'll leave you with this final thought. If Wall Street's AI algorithms are literally betting against your emotions, isn't it time you took emotion out of the equation entirely?